Tony, great to see you. Reading your latest note here on the markets, how to interpret the data, how to interpret the Fed, you kind of come out with two, I don't know, radical-ish concepts, given what we've heard from a lot of strategists these days. One, maybe we should take the Fed at its word. And two, it's difficult to pinpoint what exact level of the 10-year is going to be problematic for the market. And that latter one is interesting in particular because we've seen the 10-year has been intermittently problematic for the market. So how do you sort of think about that relationship without sort of trying to put a specific number on it?
Well, so Julie, the problem that you get in the marketplace and what creates sustainable economic and market declines is when you have a need for money and limited access to it. We have the opposite today. We have increasing amounts of money. The excess liquidity is historic. So what you look for is what happens every time coming out of the 2003 bottom, coming out of the 2009 bottom, you had a great year in the market. You had this perception of a massive recovery that was going to take hold in the Fed that was on the sidelines. And then you go into the second year. And what happens in the second year is you get an acceptance that the economy is going to come out of recession and that the Fed at some point is going to have to lift rates. So it's that volatility of long-term interest rates that creates that corrective period in both 2004 and then again in 2010. So long-winded way of saying at this point, where you look for trouble is when the rise in rates starts to cut back on financial conditions. In other words, you have tightening financial conditions. Currently, as I said before, it's the opposite. So corporate rates remain historically low. That's very stimulative for corporate refinance programs that are lowering interest expense. It's really some macroeconomic backdrop right now.
So Tony, it sounds like at least short term, staying long the market.
Well, our plan has been we increased exposure. We've been bullish pretty well, as you guys all know, kind of known for that. But last September and October into the September swoon and then that October whoosh, we wanted to really increase the economic reacceleration exposure. So small over large, commodities, emerging over developed, cyclical over defensive. In the beginning of March, that kind of got reflected. So growth has had this bounce versus value. And then I think 3 weeks ago, we did a relative downgrade of the financials because they had had such a move in anticipation of higher rates. So some of it is in there. So shorter term, what we've had is a heck of a lot of choppiness. Like if you look at the S&P 500, it looks like we're all good. We're grinding higher. Everything's bullish. But that's not been true. What's been happening underneath the indexes is violent rotation day to day where the NASDAQ growth names are up big one day. The next day, the financials and cyclicals are up big. And it's back and forth, so it keeps the index elevated, whereas the majority of things are just going sideways.
Tony, this morning, I opened the Wall Street Journal, big spread on what's happening with retail traders. Bloomberg out with a similarly big story on the waning role of the individual. How are you guys thinking about that now? And I guess how have you thought through the implications of retail, both in their bull run, let's call it end of last year and the beginning of this year, and whatever the future might hold for that segment of the market?
Well, I'm gonna confirm what JJ said earlier. I think it's very healthy when more people are becoming interested in investing. But the idea that the small retail investor were creating moves in some of the stocks that went parabolic was disproven in the last couple of weeks with the family office network that had showed the incredible multi-billions of dollars of leverage that were driving some of those stocks parabolic. So I think, again, it's healthy when there's more participation. But the idea that this macro trade, think about this, guys. You got the most liquid things in the universe are the currency markets and the treasury markets. This has been one big macro reacceleration trade. You have weaker dollar, cyclical stocks, strong commodities, and weak treasuries. That's not an options-based small investor mandate. I think that there's been areas of the market that the smaller, newer investor has dominated. And then, of course, what's going to happen? I got blown up in my early investments because I didn't know exactly why and what I was buying for. I have to, I go back to what is a stock? A stock is a partnership in a company. Do you want to own a piece of a company? It's not a symbol to gamble. I had to learn that, and I think all investors ultimately learn that.
And hopefully don't suffer too much damage in the process, Tony. I do want to ask you about earnings season real quick as well, because we're about to begin getting those reports in earnest. What do you think that's going to do for the market? Given where we are already, are we going to get another lift, another leg upward from those first quarter earnings reports?
I don't. Again, I think we're in this digestion period, Julie. I don't think it's going to have anything to do with earnings or interest rates. I think there's just going to be this volatility. There hasn't been a meaningful correction since last September and October. By meaningful, something. It's been a rolling correction. So you had NASDAQ down 10%, you had small caps down 10%, you even had the banks down almost 10% from when we downgraded an intraday into intraday low. So there's been this rolling correction. So I'm hesitant to say that there's going to be a single catalyst that's going to make it go up or down. I think it's just this excess liquidity backdrop is ultimately going to protect the downside to some degree. Earnings are going to be terrific. The current consensus is for 23% growth in earnings, and I think it could beat that.